So again, as I mentioned earlier, price, volume, and time. That's the components of the volume weighted average price. Time is the most subjective because we all have different time frames. I'm a swing trader. Some people listening might be investors. Some people might be scalpers, which, they're trading off 30-second charts, let's say. Whatever it is, that's your time frame. It's not a bad time frame. You can't feel bad. Let other people say, oh, you shouldn't do this or do that. You do whatever works for you. So what we want to do is say who's in control, the buyers or the sellers, or do we have this equilibrium? So when the demand is greater than supply, obviously what happens? Prices move higher. That's a stage 2 uptrend. When we have sideways action, it's either after a rally and it starts to turn sideways, possibly distribution that leads to a decline, or after a decline, it accumulates and then leads to an uptrend. When supply is greater than demand, prices move lower to find enough demand to support the prices. So when we look at a volume weighted average price, and here this is, just one day, and these are, I think, 1 minute candles. Here, this market gapped up this particular day. So you anchor a volume weighted average price from the very first minute of the day. Market rallies up, pulls back, finds buyers who are defending that volume weighted average price level, has another rally, stays above that VWAP, stays above it, crosses back and forth. Now we're kind of in this equilibrium level. It's gone sideways. If it broke back above this 365.50, it would have been a continuation. Instead, it broke down through this little support in the VWAP, and then the sellers took control. We had lower highs and lower lows. So for a shorter term day trader, there's a great opportunity here. Let's say we just shorted it right here as this little rally, or let's say even right here at 363.55, let's call it, with our stop just above this little lower high. That's a great little day trade on these 2 minute candles. On a bullish time frame, what we want to see here's a 1 minute time frame. A bullish chart will tend to find buyers at the rising volume weighted average price. So if the market is above a rising volume weighted average price for the session, I don't want to short it. Some people will try to short it up here and cover for 12 cents. I'd rather look for it and say, I want to buy it as it's breaking this range here, this tight range, buy it right here with a stop, worst case under here, maybe even under this little low from a very short-term standpoint. And again, the fractal nature of the market says this could be weekly candles right here. There's no difference in the analysis. And the opposite of true is, of course, on the short side.
Sure. So why is it called anchored volume weighted average price? What are we anchored?
Yeah, good question. So the traditional volume weighted average price, the one that we hear about, the VWAP, is for 1 day. The volume weighted average price was a benchmark for institutions to say, how well is my order executed? I run a hedge fund, and I give Goldman Sachs an order to buy 200,000 or sell 200,000 shares of this stock here. It closed the prior day at 177. So I want to know, how well did they do for me? If the volume weighted average price at the end of the day is 170.80, it means the average price based on volume, every single transaction, you take the average price and divide it by the volume. The average price it traded at was, the arithmetic mean is 170.95. If they came back to me and said, hey, we sold your order at 166.50 or 168.50, I'd be like, man, that's $2 below the VWAP. You guys, what are you doing? You screwed me over. But if they, let's say they executed the bulk of the order up in here in the morning because they knew that it was going to be, a lot of pressure, or they anticipated that, and they came back to me and said, hey, we filled your order at 71.85. I'd be like, you guys are great. I'm coming back and giving you business. In the past, though, before the volume weighted average price became a benchmark in 1988, an institution had no way of knowing if they were getting robbed by their broker, which they probably were back then before we had this transparency. So that's why the VWAP was invented. The anchored volume weighted average price is when we set it from any point other than the beginning of the day. Okay. So we can anchor at the 10:15 low of the day. and we can set our anchor at that 10:15 low. It comes down, starts rallying up. We say that looks like a high volume event at 10:15 a.m. I'm going to anchor a VWAP from there and see if the buyers can maintain control from that point forward. And then it rallies up, makes a high at 1:15 p.m. and backs off, a 0.5%. I know that was an important high. I'll anchor a VWAP to that. And again, I'll do that on daily charts. I'll do that on weekly charts. I'll do it on, 30-minute time frames.
Got it.
So the anchoring bias is, something that it's called a heuristic. It's, it's that our decisions are based on, our anchor point in our mind. So for instance, the price we pay for a stock, we're anchored to that. That's how we determine success or failure in the market. If I pay $30.52 and the stock goes to 33, I know that compared to my cost, that's the most important price, what I paid. If instead it's down at 29, well, then I know I'm not doing a great job. So I'm anchored to that. We're all anchored to a certain, price. So price has memory. It wiggles into our brain and, gets stuck there. So it's how we measure our success. The way to really think about it, the volume weighted average price is dollar cost average, basically. It's the same thing. If you took $1,000 each month and invested it in Apple, in this case, the stock is trading between 225 and 197 when I put this together. So in the very first month, you bought five shares at a cost of $199.23. That was your $1,000. Well, the next month, the stock dropped to 190. So it was down 9 points. So we were able to buy 5.2 shares. When the stock was up at 235, we bought 4.25 shares. So at the end of this, what we want to say is, here's our volume weighted average price.
Sure.
Our average price was 206.60. That's our cost basis. That's our VWAP, our volume weighted average price. That's the way to think about it. It makes a lot more sense when people think about it instead of an institution buying 500,000 shares or whatever. So we're anchored to that. We want to know, some of the guidelines is very similar to a traditional time-based moving average. This is a cumulative average. The volume weighted average price takes it from one point forward and adds up all the volume, adds up all the prices times the number of shares divides by the volume. So we want to be aware, just like a 50-day moving average. Is it rising? If it's rising, it means generally we give the benefit of the doubt to the buyers. If it's declining, we give the benefit of the doubt to the sellers. If it's flat and the prices are going back and forth above and below it, a lot of people will say, well, that volume weighted average price is useless, Brian. It's just going back and forth above and below it. That's the beauty of it. That's the value right there. It tells us there's no trend here. Stay away from it. Wait for it to break the resistance. By that break of the resistance, set your stop and see if a new trend emerges. It's in alignment with that longer term time frame. So there's value in recognizing those neutral periods because it says stay away. Don't try to force the trade when nothing's happening.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.